All right, welcome to this explainer. Today, we're doing something really fun. We're going to put a highly volatile clinical stage biotech company through an absolute gauntlet of legendary investing frameworks. Valuing a biotech is notoriously tricky, right? But applying traditional models to it actually reveals some incredible hidden insights. So let's jump right in.
$1.14 billion. That is the market cap of Wave Life Sciences. They've got massive pharmaceutical backing, but here's the kicker. They're operating without a single fully approved drug on the market. Trading at roughly $6 a share, this company represents a classic biotech paradox. You have enormous scientific potential constantly weighing against, well, zero current commercial product revenue.
So how exactly do you value a billion-dollar biotech in that exact situation? It's a fascinating challenge. To figure it out, we're going to merge their clinical and financial data with the classic battle-tested models of Warren Buffett, Peter Lynch, and Benjamin Graham, along with some modern quantitative methods. We need to find out if this company actually has a margin of safety, or if the clinical risks simply outweigh the rewards.
Here is our roadmap for today. We'll kick things off with a quick company snapshot, then view it through the Buffett and Graham lenses, followed by the Peter Lynch lens. After that, we'll dive into some DCF valuation assumptions, explore a few alternative models, and wrap it all up with our final synthesis and recommendation.
Okay, part 1, company snapshot. Let's arm ourselves with the vital stats and establish a baseline. Now, what's really interesting here is that while Wave operates at a net loss of $26.1 million, their Q1 revenue just jumped dramatically to $38.2 million. That's entirely thanks to collaboration milestones with GSK. And that gives them a massive $544 million cash cushion. Sure, their earnings per share sits at a negative 13 cents, but that cash runway, it's absolutely critical. Management expects it to fund operations well into the third quarter of 2028. You know, for a clinical stage biotech, cash is literally oxygen, and Wave is breathing pretty easy for now.
Remember, a biotech's valuation is entirely tied to the probability of FDA approval. And looking ahead to 2026, their calendar is just loaded with massive regulatory milestones. We're talking obesity, liver disease, and muscular dystrophy. Their WVE-007 obesity drug is moving right into Phase 2A multi-dose trials after showing profound reductions in visceral fat. Then, their WVE-006 RNA editing program for AATD is seeking accelerated approval feedback mid-year. And finally, their Duchenne muscular dystrophy drug is targeting an NDA filing in late 2026. These are true binary events. They will absolutely dictate the future stock price.
Moving right along to Section 2, the Buffett and Graham lenses, the ultimate test of conservative value investing.
We all know Warren Buffett demands consistent owner earnings and a high return on equity. But Wave? They're deliberately burning cash on R&D for their Spina and AIMer platforms. This means it currently completely fails Buffett's strict criteria for a buy. They might have a solid intellectual property moat with their proprietary RNA editing tech, but those massive R&D operating expenses just wipe out any concept of predictable owner earnings. So actually, scratch that. While Buffett might admire the underlying science, there is absolutely no way he's touching this stock at this stage.
Now, taking Benjamin Graham's defensive spreadsheet approach, the stock does pass on adequate size and financial condition. But, and it's a really big but, it fails spectacularly on earning stability and dividends. Graham wants a strong current ratio and manageable debt, which, to be fair, Wave actually has, thanks to that huge pile of cash. However, the total lack of a dividend record, plus not having 10 years of stable earnings, means a defensive investor following Graham's strict rules is filtering this out immediately.
And here's where it gets kind of funny. Because Wave's EPS is a negative 13 cents, Graham's intrinsic value formula literally breaks. His classic formula requires you to take the square root of 22.5 times EPS times book value per share, and well, it requires positive earnings. When you plug in a negative number, the math just stops working. You literally get an undefined margin of safety. It turns out vintage financial models really don't like it when you lose money. Until they reach commercial profitability, Graham is completely avoiding this one.
All right, Section 3, the Peter Lynch lens. Let's shift our perspective to story-driven investing and categorize growth.
Lynch loved to find companies that Wall Street was ignoring, but he categorized them meticulously. He'd probably slot Wave in as a fast grower because of that massive 316% year-over-year revenue spike, or maybe an asset play based purely on their proprietary RNA editing technology and cash reserves. Now, that revenue jump in Q1 is undeniably fast growth, though we do have to note it's driven by deferred collaboration revenue from GSK, not recurring drug sales. And again, because the EPS is negative, we can't calculate a standard PEG ratio. But Lynch, he would absolutely love their rock-solid balance sheet.
But here's a massive caveat. Notice the nearly 90% institutional ownership by giants like GSK and RA Capital. That is a metric Lynch usually views as a negative. He prefers undiscovered, under-the-radar stocks. When you have 138 institutional buyers pouring money into a stock, it's a classic crowded trade. Because of that, Lynch would likely rate this a hold and wait for a significant dip below $5 where retail investors might flee, but the underlying assets remain totally intact.
Let's move to Section 4, DCF Valuation Assumptions, Projecting the Unpredictable.
Because their current cash flow is negative, our DCF methodology requires us to assume future free cash flows driven by successful Phase 2 and 3 milestones, and we have to discount heavily for clinical failure risk. We're projecting out based on their cash runway to 2028, modeling in potential milestone payments from GSK, and trying to establish a terminal value, assuming at least one of their lead therapies, like that WVE-007 obesity drug, actually reaches commercialization.
By running a sensitivity table, we assign a massive, highly conservative 15% discount rate. That weighted average cost of capital is pretty standard for biotech, to account for the grave reality of FDA trial failures. And under these strict parameters, the fair value plummets below its current trading price. Basically, the DCF model suggests the stock is currently fairly valued, or even slightly overvalued at $6, unless you're willing to assume a much lower risk premium.
So Section 5, Alternative Valuation Models. Let's look beyond traditional cash flows. Because traditional models struggle here, let's look at multiples. If we strip out their $544 million cash pile, Wave's enterprise value is roughly $596 million. That actually gives them a very reasonable EV to revenue multiple compared to the highly inflated averages of peer biotechs. Think about it. You're effectively paying less than $600 million for an entire pipeline of RNA medicines, which includes a potentially best-in-class obesity treatment that induces fat loss without muscle loss. In the biotech world, where acquisitions frequently happen in the multi-billions, this enterprise value looks quite attractive.
We can also use a sum-of-the-parts model. Let's assume the obesity candidate WVE-007 and the AATD program WVE-006 each have standalone enterprise values. If they hit their Phase 2 endpoints, those values easily eclipse the current market cap. I mean, just the obesity market alone is a multi-billion-dollar opportunity. If 007 proves it can compete with GLP-1 agonists by preserving muscle mass, that single asset could be worth significantly more than Wave's entire current $1.14 billion valuation. The sheer upside is completely transformative.
Finally, Section 6, Synthesis and Recommendation. It's time to bring this gauntlet to a close.
Our final master scorecard reveals a very clear divide. Classical value investors like Buffett and Graham scream avoid, while forward-looking models suggest the stock is a speculative buy based purely on pipeline potential. Our DCF model puts the fair value right around the current $6 mark, making it a hold for quantitative investors. But the sum of the parts analysis strongly signals a buy. It suggests the market just isn't fully pricing in the immense optionality of their broad RNA pipeline.
Ultimately, you're weighing their immense cash runway and cutting-edge RNA science directly against the binary risk of FDA trial failures and a total lack of predictable owner earnings. The downside is protected somewhat by that $500 million in cash and the robust backing from GSK, which definitely validates the science. The upside is immense, but the risks are equally stark. If the Ion Light obesity trial or the Rester SN8 trial stumbles, the stock is going to punish investors severely.
So, our final thought to leave you with today. Considering the massive upside of an obesity drug breakthrough, does Wave Life Sciences offer a wide enough margin of safety for your portfolio? Well, if you're a strict value investor, the answer is clearly no. But if you're willing to embrace a calculated, story-driven asset play with a really strong cash floor, this is absolutely one to watch very closely. Thank you for joining me on this explainer, and keep learning.